Hey everybody, Tim Albrick here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, I welcome Tony Umholtz back onto the show as Senior Vice President of Mortgage Banking at First Horizon. On today's show, we discuss 4 timely questions that prospective homebuyers must answer, including whether to buy now versus wait, rules of thumb that lenders are using to determine the lending limits, the potential impact of the recent settlement from the National Association of Realtors, and the current state of how student loan payments are being factored into the lending calculations. If you're in the market to buy a home in 2024, we've got a good one for you this week. All right, let's hear from today's sponsor, First Horizon, and then we'll jump into the show. Does saving 20% for a down payment on a home feel like an uphill battle? It's no secret that pharmacists have a lot of competing financial priorities, including high student loan debt, meaning that saving 20% for a down payment on a home may take years. For several years now, we've been partnering with First Horizon, who offers a professional home loan option, aka a doctor or pharmacist loan, that requires a 3% down payment for a single-family home or townhome for first-time home buyers, has no PMI, and offers a 30-year fixed-rate mortgage on home loans up to $766,550 in most areas. The pharmacist home loan is available in all states except Alaska and Hawaii and can be used to purchase condos as well. However, rates may be higher and a condo review has to be completed. While I've personally worked with First Horizon before and had a great experience with Tony and his team, don't just take it from me. Here's what Peyton from Tyler, Texas had to say about his experience with First Horizon. Aaron, Cindy, and Marilyn were very easy to work with. As a first-time home buyer, I shopped around for lenders at the onset of the process. Aaron was always very quick to reply and provide me with any details I requested in order to move forward in my decision to select a lender. Once I selected First Horizon, Marilyn and Cindy did a great job of keeping my wife and I informed of the process. Closing was a breeze yesterday at the title office, and I sincerely appreciate the team going above and beyond to keep my interest rates locked despite extending closing due to negotiations with the seller. I've already shared my positive experience with many pharmacist-only groups, and I look forward to my brother, also a pharmacist, refinancing with you guys when he decides to. So to check out the requirements for First Horizon's pharmacist home loan and to start the pre-approval process, visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. Tony, welcome back to the show.
Hey, Tim, good to see you. Thanks for having me.
Always appreciate having your perspective and expertise to bring to our listeners that are potentially in the market for buying a house. And we had you last on the podcast earlier in the spring, episode 348. We discussed 2024 housing market trends. Today, we're going to continue that discussion, knowing that this market is fluid, shifting and moving rapidly. And specifically, we're going to talk about 4 timely questions that we think home buyers must answer. But before we get into that, Tony, what's the latest that you're seeing in terms of trends out there in the market at the time of recording this, end of May of 2024? I know you mentioned to me before we hit record some interesting trends on inventory, maybe some levels building in certain markets. Would love to hear your perspective.
Sure. So, you know, times have changed a bit. If we look back from 2 years ago till now, these interest rates, the Fed has been on this mission to quiet inflation, right? We got to get inflation down. It's been a very tough environment when it comes to inflation the last couple of years. And the good news is we're starting to see some things happen. And one thing that's been building in different parts of the country. Now, every part of the country can vary, but in Tampa Bay, for example, and in Florida, we've seen a lot of inventory growth. A lot of other parts of the country have too. Austin, Texas, I know, is building an inventory. So we're seeing more inventory, more availability for buyers that wasn't there in the past. And I think, that's part of a normalization. We're still not completely normal, but we are getting closer. So we're getting closer.
Yeah, it feels like there's some slight shifts happening to be more buyer friendly. We were just talking before the episode. You shared a story from your team of some negotiations happening where, there were some concessions and things from a seller that maybe we wouldn't have saw, 6 months ago, 12 months ago. And again, to your point, every market is different. We need more inventory here in Columbus, Ohio, for sure. There's a lot of demand. So everyone's market is different, but it does feel like we're starting to see some shifts where, the market's becoming a little bit more friendly to the buyer. I know for those that are searching, it probably does not feel like that right now, but be patient, and we're obviously anxiously waiting to see what happens with interest rates as well.
Yes, I definitely seeing a shift. It's becoming much more of a buyer's market. Repairs are being, concessions are being made. They're, like we had talked about, the sellers are willing to do some of this work to the home where they weren't before. When these inspections come back and there's little things, they're willing to make
Hmm.
those repairs now where they weren't in the past. So, definitely some positive trends for buyers.
So again, we're going to talk through four timely questions that home buyers must answer. Again, we're recording here at the end of May 2024. So Tony, question number one, I think one that many people are waiting, thinking about is, should I buy now? Should I wait until interest rates drop? We discussed that in a previous episode. I think this provides an interesting question because supply and demand, when rates come down, in theory, we're going to have more people that are into the market searching for a home. We did see rates tick down a little bit here in the last week. So what are your thoughts on some of the trends that are happening around interest rates and this decision of, hey, buy now versus wait?
Yeah, there's a lot that goes into that, Tim. It's great question. I think, the first thing we would want to talk about is everyone's situation is different, right?
Yeah.
I've always believed in 22 years in this industry, like if someone's going to be in an area for 5 years or more, when you look at the alternative renting, right, versus owning, I think it makes sense to own if you're in a 5 year span, no matter what the environment, right? I think because it just rents go up over time, right? You don't build equity. Even if values stayed the same, you're going to come out ahead in 5 years if values were zero, right? Zero appreciation, right? So you're going to benefit by owning that home, even if there's no appreciation. So I think that'd be the first thing I'd say. Like if it's up to the individual, but if you're
Hmm.
renting and that's the alternative, and you're going to see escalating rents because rents are still going up every year, I think owning's the way to go. As far as like timing the market, which is always hard to do, there's pros and cons right now. I think inventory is building; it's becoming more favorable, like we discussed. Interest rates have come down slightly. With interest rates, I'll give you guys I'll give you guys my thoughts on this. And again, this is just all these multiple sources that I monitor,
Yeah.
and and there's a couple of different thoughts here. So number one, we're starting to see different consumers, different spectrums really being affected. Um, uh, those in the lower income earners, it's really starting to, you're seeing credit card debt multiply. Interest rates on credit
Yeah.
card debt has gone up. There's a
Hmm.
segment of the population that's really struggling financially. We're starting to see more defaults on car payments.
Hmm.
Not as much on mortgages, but on car payments we are, and some other different retail items. So that tells you that that could drag on the economy. So that's one end of the spectrum. The other end of the spectrum is we have a lot of people like baby boomers, for example, no debt, right? So they're not dealing with any credit cards. Their income's slightly rising. We have, financial markets have gone up. Stock bond
Hmm.
market has risen. We've got high yields on CDs and
Yeah.
treasury bonds. So they're able to spend and they're spending a lot, right? So we've got one segment of the population doing really well and another not.
Hmm.
So it's just how long is that going to drag on the economy? And we're seeing businesses start pulling back a little bit. So that being said, that's all things that line up with interest rates falling. It really
Hmm.
does, because we are seeing this gradual slowdown. Rates came down the past 2 weeks because we got a really pretty bad number on retail sales, and those things kind of are showing this slowdown. That being said, commodity prices are going up, and what does that tell us, Tim? That tells us that that's an inflationary sign, right?
Hmm.
So it's a mixed bag right now. It's hard to say rates are going to go straight down. Um, it's really tough. So I wouldn't say we can't completely bank on lower rates. We definitely are slowing, and there's probably an outlook that rates could be lower in the future, but we don't always know for sure, right? There is some signal saying higher rates this could be the new normal for a while. So when we're making a home buying decision, we wouldn't want to just say, hey, rates are going to be lower in a
Yeah.
year. That's what I'm buying. It's got to say, does this fit my lifestyle now? Is my alternative renting? If I'm living rent free with family and it's not a problem to be in the, living with family, it might be okay. But if you're renting
Hmm.
and you're going to be in that area for more than 5 years, that's where I think buying makes sense no matter what the market is.
Yeah, I'm glad you said that, Tony, because I feel like when there's so much news coming at us, as there has been with market conditions, rates, will they drop, when will they drop, inflation, et cetera, we tend to run the risk of getting down these rabbit holes that drive our decision making. And they're important information we've got to consider, but we got to step back and look at the bigger picture. Where does the home purchase fit within the context of the rest of the
Right.
financial plan? And if we think about this as a decision tree, from there, yes or no, okay, how are the market conditions impacting our ability to buy a home? And what does that do in terms of purchase price, financing options, all those things? And sometimes we work
Absolutely.
bottom up when we really need to start with those bigger questions.
I have one more thing I'll add. Just and it just kind of piggybacks on Warren Buffett, right? And you know, you want to go against the grain in investments and in life in a lot of ways. I think his quote was, "I buy when there's blood in the streets." Is when he buys stocks, right? When things are really bad, and when there's euphoria, he sells. So you kind of look at the housing market, and I've looked at that over the years, and maybe outside of COVID, just what happened in COVID, it's always kind of been when the market's down, it's kind of a down year. I think it's always been a better time to buy historically in real estate too. When
Mm,
everyone's buying, then you're competing with everyone, and it's
yeah,
just you don't get as good of a deal. So
yeah.
I kind of looked at that in my own life. When I buy, it seems like when things were slower in the market, I always did better, versus when everyone's looking. So
Yeah, and I have a feeling, time will tell, but I have a feeling, maybe this time next year, maybe sooner, maybe a little bit later, you and I are going to be talking about, an important topic around refinancing that we haven't talked about in a
right,
long time on the show because it just hasn't made a whole lot of sense. So,
right.
more to come in the future. But obviously, if we see rates drop, there's going to be a big interest in the market out there from a refinance perspective. Great stuff. Okay, so that was the first question. Is it worth waiting to buy until interest rates drop? So buy now versus wait. Second question is around some of the rules of thumb that lenders are using from a pre-approval process and determining the amount of home that one can afford, one can purchase. And Tony, just given the rise in home prices, given the rise in interest rates, obviously driving up monthly payments, pharmacist incomes have gone up, but they haven't gone up that much. And so I have a feeling
Right.
that, we're seeing the impact of home prices and interest rates have an impact on their debt to income ratios, which are important from a lending perspective. So what are the rules of thumb? Is the 28-36 rule still relevant? What are lenders using now?
It is relevant to some degree, but actually the back end ratio, the 36%, is actually 43. So, and it depends on the product too. So, like the product, with less than 20% down, you're typically going to have to stay at that 43% threshold. So that means your total debts, new mortgage included, car payments, student loans, the total debts cannot be more than 43% of your gross income. So it's important to remember it's gross income, it's not
Yep.
net income. Okay. So if your earnings are $10,000 a month gross, your total obligations per month can be 4,300. Okay. Simple math there.
Hmm.
Now, if you're going to bring more money to the table, like 20% down, you can often get approved higher, so up to 49%, maybe even 50% in some cases. Um, FHA loans, we can get even higher sometimes. It's interesting. So, but those are with different LTVs.
Yep.
Typically, more larger down payments are going to give you more flexibility on the debt to income ratio. And that's what we are approving you for as a lender, and what the lending community can approve you for. That doesn't necessarily mean it's the right thing for you.
Right.
So,
Yeah, great point. And so we've seen that kind of bump up over time. And again, to your point, every product is different. So no general rule of thumb. But the
right,
example there is a good one, right? Remember, it's gross income. So if someone's earning $10,000 per year, you mentioned that 36 shifting to 43.
right,
So that would be all debts for 4,300, right? Or less
right.
of the
Total debts, yeah.
10,000. Now, just to add on to that a little bit, in this market, Tony, and I'm specifically thinking of existing homeowners that are looking to move or make a purchase that are trying to get themselves in a position where maybe they don't have to make a contingent offer, right? So, hey, can I get a second loan? Even if they're not going to carry that loan for a long period of time, but wanting to be able to make an offer on a home without a contingency on the
Right.
sale of their current home. Just talk to us about how that impacts it. In that point, you then would have two mortgages, right, that are going into that 43% equation.
That's right. So any liabilities you add, so like for example, what's popular is a home equity line of credit. if you still own your home and you're trying to buy a new home without selling your current home, well, that home equity line of credit has to be counted in your debt to income ratio going forward. And it's a popular strategy. It's almost like a bridge loan. We have some clients that are trying to do a few repairs to their home, but want to buy this other house,
Yeah.
and they need to bridge the equity over for the down payment. Now, that new home equity line, for example, would count in their debt to income ratio, or cash out refinance. We do cash out refinances as well, where because those rates are lower than home equity lines
Hmm.
generally. And let's say we pull $100,000 out, that new mortgage payment would be calculated in your debt to income ratio. So any new loans you take are calculated in your debt to income ratio.
Awesome. Great stuff there. So, third question, I want to talk a little bit about the maybe somewhat nebulous NAR settlement and what's going on there, and probably more questions, and maybe we have answers at this point in time. And we had Nate Hedrick on the show early in April. Nate's a pharmacist, real estate agent, episode 353. We'll link to that in the show notes to talk about his perspective as an agent on the NAR settlement. So, we don't necessarily need to go into all of the details on the settlement, as we've discussed that before. But Tony, would love to get your perspective as a mortgage officer. What exactly is going on here with the settlement, and how may this impact or not impact those that are currently or soon to be in the market as a home buyer?
Yeah, it's it's a moving target to some degree. It's uh, you know from our perspective as lenders, I know, and the other thing I just like to address is we don't know all the details yet, and I think we have to look at the different regional MLSs too. I think there could
Hmm.
be some regional impacts and ways of doing business that could change. It may not be a universal thing, is what I'm saying. Different areas may adopt different
Yeah.
rules in this, but just in my communications with real estate agents that we've worked with, and clearly the big thing is going to be, I think it's going to narrow the amount of realtors that are out there. I think to some degree, I think the more established agents will be still be in the markets and still do well and probably will do better. But a lot of the newer agents that may not have as big of a following or book of
Hmm.
business may not make it, right. My concern too is there are going to be some areas where the buyers may not be able to afford to pay the buyer's agents. So I think what it's going to do is it's going to professionalize a lot of things. I think buyers, first of all, I want to say this. I've worked with real estate agents for over 20 years, and some of them work extremely hard. It's a very tough occupation. When you talk about driving people to maybe 20 houses,
The
negotiating
hours.
back
Yeah.
and forth. I mean,
Hmm.
even this weekend, I had an agent call us, and they were making an offer on a really competitive house. This one was priced really well to sell. And they're still going up against multiple offers. They've been working with these buyers for months. I mean, it's a challenging occupation, and this doesn't make it any easier to some degree. But I think having a buyer's agreement with that agent. So when you select an agent that can help you, because there's a lot of value add that agents bring. Um, just in my view, we all have the internet. We all can search for properties, but when we're new to an area, we don't
Hmm.
know everything about the neighborhoods. We don't know the history of the neighborhoods, the history of that area. Was it built on an old waste management facility? I mean,
Right.
there's so much that goes into this. What kind of schools are here? What's
Hmm.
the history of these schools? What's the history of this part of town? Is this area going to appreciate? Is it a growing part of town, or is it a dying? There's so many aspects that agents do bring value. So I think I'm getting off on a tangent, but I guess what I'm getting at here is you want people to be served, have the ability to be served by agents, right?
Yeah.
And you don't want to eliminate that. So they're all going to have to sign some sort of buyer's agreement, and there will be a commission involved. And that commission will either be paid by the buyer themselves directly or could still be negotiated with the seller. And I do think, especially as we pivot into this buyer's market, that more sellers are going to be willing to pay that. And it may not be advertised that way, but I think they're going to be able to negotiate that in so the seller's essentially still paying it.
Yeah.
But if the buyer does pay it out of their pocket, they're probably still getting a little lower sales price. So in the
Hmm.
end, I think the consumer is going to do fine, but it's really not going to change a whole lot. I think it's going to change how the business is done. Um, and it may eliminate some of the agents in the industry, is what I think could happen. The good news of all this is that Fannie Mae, Freddie Mac, right, and HUD basically came out and said that if the seller does pay the buyer's agent commission, it's not going to impact the allowance for seller concessions.
Hmm.
that means is on a conventional loan, if you're putting 5% down and you can normally get 3% in sales
Hmm.
concessions, right? That, let's say the buyer agents owed 3% in sale and commission, the seller can still pay that and still pay your 3% concessions to your
Yep.
closing costs and prepaids, which is helpful, I think, is a big deal, because then we're not having that challenge as
Hmm.
well for buyers, because many people take advantage of that to have their closing costs and prepaids paid. So that's kind of where we are. I think we'll know more by the end of the summer,
Hmm.
and we can definitely dive in more. And that's just kind of my high level perspective. I'm not an expert in this, but just that's kind of what I think could happen, and I'm hopeful that this is a good thing for the industry, and it's not a negative thing.
Yeah, great summary. And I'm just really curious more than anything to see how this shakes out. If you look at listings right now, it's business as usual.
Right.
Most listings that I see here in the Columbus area, it'll list at 3%, 2.5%, something like that. So that ability to list is something I think we're going to see that change. And there certainly will be questions in some unknown territory, but how quickly will this evolve? How quickly will the disruption happen or not happen? You and I were talking a little bit before the recording about some of this shifting more on the front end and having
Right.
that agreement with the buyer's agent, especially for the first time home buyers where that down payment and coming with cash to the table for down payment closing costs is so precious, right? That's hard to do. If there's
Yes.
more cash that's needed from the buyer to pay the agent in a market or historically where that wasn't happening, I think that's going to be an interesting trend to watch into the future. But a lot of questions. I think the example you gave was a really good one of, an agent understanding a local area, understanding the schools, understanding maybe some of the things that aren't going to be put on a listing,
Right.
such as, hey, this was built on an old facility. And just going through this process a couple times, especially if you're coming from out of the area, until you are in the area, living in it every day, where you are actually driving around, experiencing it, living life like you normally would, you just can't know that. You have to rely on, other people that have expertise in the area. But I think it's also worth saying there that not all agents are created equal from a value standpoint.
Right.
It's no different than our industry in the
That's right.
financial services where the word financial planner doesn't necessarily carry a whole lot of weight. As the consumer, you have to really do your homework to say, hey, what are the credentials this person has? What is the experience? What is the value that they're charging? Is there a return on investment? And I think one of the positives of this is really shifting, that pressure, maybe some consolidation in the agent market to really, for agents to make that case from a value standpoint. So curious to see what that looks like.
Yeah, 100% agree. And it should professionalize a lot of the
Yeah.
industry in a lot of ways.
My last question for you, Tony, I know a lot of our listeners are curious about this is related to student loans. It feels like we have to come back and talk about student loans at some point on every episode. Many of our listeners, of course, are facing, significant amounts of student loan debt, especially in that first decade or so of their career. And there's just changes upon changes related to student loans that have been coming over the last year. And one of them that's coming to top of mind for me is with the new Save repayment plan. That new calculation is going into effect this summer, which is going to have some benefits for most, not all, because what's interesting about that repayment plan is the monthly payment can exceed the standard repayment plan, which isn't true with all of the other income-driven repayment plans. But for most borrowers, I think because of the adjustments to that calculation, where the federal poverty limit multiplier is going to be going up, and then the multiplier for graduate, undergraduate loans might drive down the monthly payment a little bit as well. In theory, we're going to see many people that might have a lower monthly payment on that save plan. And so my question is, we just talked about debt to income ratio. How does that feed into what you're seeing in terms of how lenders are looking at student loans and just the nuances and how quickly this is changing and how that feeds into the calculation of what that amount of student loans impacts their overall debt load?
Yeah, it's a great question, and as far as how lenders are viewing the student loans, there's two things that I would say are the main factors that we look at, right? So when a pharmacist or physician is getting out of school, they secure their first job, and they have quite a bit of student loans. We see cases, across the board, but hundreds of thousands of dollars sometimes.
Mm-hmm.
Uh, there's two ways, and the way the best way, and what we see the most is we just use the income-based repayment number, right? So a lot of times when we'll run a credit report for someone that's newly out of school, it'll state that they owe all this balance and there's a zero payment, right? So because they haven't started making
Yep.
payments. So when we run a credit bureau through Equifax, TransUnion, and Experian, it'll come back that way, right? Just saying zero is the payment amount. So that's where these two different avenues go. So number one, if you get the income-based payment letter, so let's say it's 250,000 in still student loans, and that comes back at $800 a month income-based repayment, or $500 a month. That's what we're going to use. So it'll be $500 a month on that letter, even though it's not on the credit bureau.
Yep.
Now, if it's in deferment or you're not repaying it, right, then we're going to use a factor. So in the case the product we use for pharmacists is going to be a 0.5% factor. Okay. So in that case, you'd be looking at a 1250 payment versus 500. So 1,250 because it's 0.5% per month of the total 250.
Mm-hmm.
So your ability, your buying capacity has narrowed if you don't have that income-based repayment.
Mm-hmm.
So because that factor is going to provide a larger payment than the income based. Now, that being said, that factor is lower than like an FHA loan or some other products that are out there where you're going to use 1%, right?
1%. Yep.
So it's still better than the other options, but it's not as good as the income based. So my advice is once you start working and you're on that payment plan, that's what the lender's going to use. And make sure that they have that information. That way they calculate it correctly. Because lenders may turn you down saying, hey, you owe 250, saying zero, our factor is 1%, it's 2,500 a month, you can't qualify for anything.
Yeah.
So that's the advice I'd give. I've seen that happen quite a bit over the years. So I just, do your homework on what that income-based payment will be. And if it's better than that factor, which a lot of times it is, that's what I would use that to factor into your planning ahead of time.
Yeah, Tony, this is a great example, one of many where two parts of the financial plan come together. We're talking about student loan repayment, and obviously there's a whole set of strategy with that. And from a lending perspective, you're buying a home, what that monthly payment is and how that feeds into your debt to income ratio, very relevant. And one of the common things we talk about is, deferment. In my opinion, deferment, there's still some old advice out there from people that graduated back when I did of like, hey, defer your loans if you can defer your loans, especially during like a postgraduate training period. And the problem with that, you've highlighted one here, is that for those individuals, that's going to put us into that, more of that de facto calculation that most likely is going to be a higher number that
Right.
contributes to the debt load. The other thing we often talk about is, especially for those that might qualify for something like public service loan forgiveness, deferment doesn't allow those to count as qualifying payments. And because the income driven repayment, as the name suggests, is using your income to come up with your
Right.
monthly payment, even when you're in a postgraduate training period where the thought might be, hey, I've got a lower income, therefore I need to defer, that calculation might end up, even if you have 150, 200, $250,000 debt, you might actually have a very low monthly income driven repayment plan, which would be favorable here, but also be favorable when it comes to something like loan forgiveness payments and those payments counting. So not advice by any means, but certainly something to think about. And a good example just of how these pieces are very much interconnected.
Absolutely.
Tony, if I could put a fifth question in front of you that I actually was just thinking about as we were recording, knowing we're in this higher interest rate market, I would suspect this is a time period where we're seeing more ARM products out there that are being promoted. So ARMs, adjustable rate mortgage products. What are your thoughts and kind of, people looking at those where, hey, maybe an ARM product is being promoted, so I'm thinking of something like a 10 or 15-year ARM, even if it's amortized over 30 years with the idea that, hey, maybe we're going to save a little bit on interest now, but there's this question in the future. So, when I refinanced my home last in 2000 and I don't know, somewhere around the pandemic, you know, 30-year conventional at high twos, low threes, it's a no-brainer, right? Obviously, we're in a different interest rate market. So just quick thoughts on kind of ARM products in this market.
You know, it, it's funny, the ARM products, especially right when the Fed took off with their interest rate rising or raises, and ARMs had a pretty, meaningful spread below the fixed rates.
Mm-hmm.
So the only area I see, and I'll give you the pros and cons of ARMs, the only area where I'm writing a good amount of ARMs are on jumbo mortgages right now.
Okay.
Just because those jumbo fixed rates are still higher, more elevated than the ARMs. But it's compressed a lot. So it used to be like a 1% spread, maybe in
Mm-hmm.
early, mid 22 and end of 22, 23. It just kind of kept doing this. You know why? Because the Fed kept increasing the short end of the yield curve, right? So that's where we had this. That's why we have an inverted yield curve. So what I don't want to get into too much technicality, but like the 2-year Treasury note today is actually higher than the 10-year
Mm-hmm.
and the 30-year, right? So it's inverted. Short-term rates are higher than
Long.
long-term rates,
Mm-hmm.
which typically means rates are going to come down in the future, right? Is typically what that means. But ARM still makes sense on the higher end loans. It possibly could on conventional loans. The only challenge is with ARMs, they typically are considered riskier in the eyes of the lender, meaning we want more money down, right? We're not going to do it
Okay.
with 3 or 5%. The only product we have one product that'll do 100% ARM. It's for MDs only, but we MDs and DOs. But outside of that, none of the products really make sense unless you put 20% down.
Yeah.
So if
Okay.
someone has 20% to put down, the ARM could make sense. It used to make even more sense, but the yield curve has gotten pumped up so much, and frankly, the fixed rates have come down.
Mm-hmm.
The 30-year fixed is getting better especially on conventional loans. FHA loans are incredibly the spread on FHA loans are way down. I mean, I think the other day, I mean, I hadn't seen them, down in the, pretty far down in the sixes
Mm-hmm.
for FHA. Now, so there is PMI, but
Yep.
but anyway, I guess what I'm getting at is I think there's better fixed rate options for most people right now, unless they're higher end loans, if that makes sense. But it's a great question. The ARMs are definitely still viable for larger jumbo loans, and in
When
most markets, that's over
okay.
766. Yeah,
You answered my question. I said, hey, what do you define as a jumbo loan for folks that
yeah,
are listening, wondering? So awesome. Thank you. Let's wrap up by talking about the product that you offer at First Horizon for the pharmacist home loan. I think many of our listeners, we've talked about, hey, some of the challenges potentially of getting to that down payment. Obviously, that down payment amount, if we think of a conventional 20%, where home prices are today versus 5 years ago, that's put further pressure on that, cash for the down payment. So talk to us about the pharmacist home loan through First Horizon, who it's for, maximum loan amounts, down payment requirements, and then we'll point our listeners to more information from there.
sure, sure. So the again the product, it's been a great option for many, and it's been really neat to see so many people benefit from it. And it allows, if you're a first time buyer, you can put as little as 3% down. And if you've purchased in the past, then or owned a home in the past, it would be 5% down. Okay, no PMI, so there's no mortgage insurance. That's the real benefit. There's no prepayment penalty either, so you can refinance in the next couple of years if we see rates dip like we think could happen. There's also a minimum credit score. It's 700. So the minimum credit score hurdle is 700,
Mhm.
and the maximum loan amount is 500 is the maximum loan amount. Um, so that's a quick snapshot of it. And there's not a hefty amount of reserve requirements. It's a pretty user friendly loan for most, especially if you're buying your first home. And we generally have 30-year fixed options under that
Mhm.
product.
So for those that are listening that are in a higher cost of living area saying, hey, I'd love to buy under 766, but I live on the West Coast. I live in the Northeast. I live in, the DC, Virginia area. This doesn't mean there's not an opportunity to work with First Horizon. Tony mentioned the jumbo loans. There are other options available when you get to those higher loan amounts. And I think, Tony, as we've
Right.
talked about on previous shows, a good lender is not going to put one solution towards everyone. It's, hey, for your individual solution, what is the best option? Is it the
Right.
pharmacist home loan? Is it an FHA loan? Perhaps a VA loan or other products. So that lender relationship and really determining what the best fit is so important. And we've got more information available on the website. If you go to yourfinancialpharmacist.com/home-loan, you can learn more about the First Horizon Pharmacist Home Loan product. And from there, we can get you in contact with Tony and the team to learn more. So, Tony, as always, great stuff. Thanks so much for coming on the show.
Hey, thanks for having me, Tim. Always great to be with you here.
Thank you. Have a good one.
You too.
Before we wrap up today's show, I want to again thank this week's sponsor of the Your Financial Pharmacist podcast, First Horizon. We're glad to have found a solution for pharmacists that are unable to save 20% for a down payment on a home. A lot of pharmacists and the YFP community have taken advantage of First Horizon's Pharmacist Home Loan, which requires a 3% down payment for a single-family home or townhome for first-time home buyers and has no PMI on a 30-year fixed-rate mortgage. To learn more about the requirements for First Horizon's Pharmacist Home Loan and to get started with the pre-approval process, you can visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.